Hey everyone, and welcome to this explainer. Okay, so as financial advisors look out toward the horizon, our goal today is to really break down the complex 2026 market outlook. We're going to translate all those expert signals into clear, actionable insights for you. We aren't just going to talk about what's happening. We're diving into exactly how top financial professionals are interpreting these massive macroeconomic shifts to manage risk, spot the next big cycle, and ultimately build wealth. We're taking all that noise, the confusing Wall Street jargon, the conflicting headlines, and we're boiling it all down into a clear, easy-to-follow roadmap.
So here's our roadmap for today. We'll be looking at beyond the AI boom, banking on deregulation, the 2026 IPO pipeline, crypto as potentially the next AI, the 10-year Treasury key, and finally, unlocking economic growth.
Let's kick things off with Section 1, Beyond the AI Boom, a Shifting Landscape.
Now, before we even try to look ahead to 2026, we absolutely have to acknowledge the sheer magnitude of the returns we saw in 2025. I mean, it marked a third straight year of double-digit market gains, but they were intensely concentrated in all that optimism around artificial intelligence. Alphabet surged an unbelievable 65%, and NVIDIA climbed 40%. It's wild. But, from an advisory perspective, this kind of success breeds a very specific danger. We're talking about concentration risk. When your portfolio's growth relies entirely on just 2 or 3 mega-cap tech stocks right at the absolute peak of a cycle, it becomes incredibly vulnerable to sudden pullbacks. Top advisors know that what led the market yesterday rarely leads it tomorrow. The driving forces are changing, and they're changing fast.
Okay, let's really dive into this. The expert consensus for 2026 is that we're going to see a massive rotation. We're shifting away from a market that's just totally dominated by a handful of tech giants, and we're entering what advisors are calling a broadening out phase. So as global central banks ease up on monetary policy and start lowering interest rates, the smart money is actually moving toward indices like the Russell 2000, which tracks smaller domestic companies. Now you might be wondering, why does this matter? Well, small-cap companies are super reliant on debt to fund their operations. When interest rates drop, the cost to service all that debt absolutely plummets. This creates a huge, immediate boost to their bottom line, a boost that those cash-rich tech giants just don't get. At the exact same time, heavily undervalued or cheap financials are perfectly positioned to catch up as capital rotates out of tech and pours into more traditional, value-oriented sectors.
All right, moving right along to Section 2, Banking on Deregulation, the efficiency play.
So while the tech giants spent all of 2025 building artificial intelligence, it turns out the banking sector is setting up to be its greatest practical beneficiary. AI is literally quietly revolutionizing back-end banking operations right now. Things like routine compliance checks, risk modeling, even customer service, they're all being fully automated. This leads to a much softer labor model, which drastically reduces what businesses call SG&A, or selling, general, and administrative expenses. But here's the kicker. The biggest catalyst for 2026 is actually deregulation. The Office of the Comptroller of the Currency, the OCC, is signaling a really vital regulatory threshold of $700 billion in assets. In the banking world, scale is literally everything, because the cost of regulatory compliance is just insanely high. By merging to hit that $700 billion mark, these regional banks can spread those massive fixed compliance costs over a much larger asset base. Experts expect this to trigger a furious race of mergers and acquisitions, which presents some massive opportunities for investors who get positioned ahead of the consolidation. And this brilliantly illustrates a point made by Anton Schutz, the president of Menden Capital Advisors. He stated point blank, it's all going to show up in earnings. From a wealth management perspective, this right here is the ultimate payoff. All those efficiency gains from AI, the slashed labor costs, the strategic mergers, they aren't just abstract corporate strategies. They flow directly into expanding profit margins. And you know how this goes. When margins expand, earnings per share skyrocket and stock valuations follow right along. Right now, top advisors are aggressively modeling these exact efficiency metrics to spot the specific banks that are going to completely outperform expectations in their upcoming quarterly reports. Next up is Section 3, the 2026 IPO pipeline, blockbusters waiting. Okay, so the delayed initial public offering market is finally uncorking, and the sheer volume of capital just waiting in the wings is frankly staggering. We are talking about absolute blockbusters here. Alphabet-backed Motive is preparing to debut. Massive AI titans like Databricks, Anthropic, and potentially even OpenAI are eyeing late 2026 or early 2027. And then there is SpaceX. They are moving ahead with plans for a $30 billion capital raise. To put that massive number into perspective for a second, the largest IPO in global history was Saudi Aramco, and they raised $29.4 billion. SpaceX is looking to top the largest public debut ever, and they're doing it purely through a private raise. It's a truly monumental concentration of wealth and innovation. But it also highlights a pretty frustrating reality. These massive early-stage gains are largely locked behind closed doors. They're accessible only to giant institutions and venture capital firms, which basically leaves the everyday retail investor on the outside looking in.
Which brings us to Section 4, Crypto, the next AI, the consumer shift.
I want you to consider this really bold prediction from Marcus Lemonis. He said blockchain and crypto could be the AI story of 2026. This actually touches on a super fascinating psychological phenomenon in the markets: fatigue. After a massive multi-year run, investors often experience AI fatigue. Because capital is relentlessly impatient, right? It's always hunting for that next asymmetrical growth opportunity, the next shiny object promising exponential returns. Lemonis is suggesting that the explosive, market-defining momentum we just witnessed with artificial intelligence is actively transferring over to digital currency and blockchain infrastructure as we head into 2026.
So it begs a really intriguing question. Think about it. Why would everyday consumers choose a digital coin over, say, literal rockets going to Mars? Well, the answer really comes down to access and market mechanics. Like we talked about, those massive institutional IPOs and private raises are restricted by high capital barriers and accredited investor laws. Conversely, the retail investor narrative naturally gravitates toward crypto because, well, it's frictionless. It trades 24 hours a day, 7 days a week, and it allows for fractional ownership. That means anyone can participate with just a few dollars. Furthermore, financial advisors keep a really close eye on the first and second quarters of the year. Why? Because that's when billions of dollars in tax refunds hit consumer bank accounts. Historically, everyday retail investors don't take that newfound liquidity and lock it into boring index funds. No, they deploy it into highly accessible spaces like blockchain because they firmly believe it holds that asymmetric, life-changing potential that the institutional gatekeepers usually reserve for themselves.
Let's move to and see how this builds into Section 5, the 10-year Treasury key, bedrock of the economy.
Okay, so underneath all the crazy stock market rallies and crypto surges, there lies the actual bedrock of the global economy: interest rates. Right now, the Federal Reserve is caught in a super complex dual mandate. They're basically playing a high-stakes game of financial whack-a-mole, trying to manage stubborn inflation while also trying to prevent widespread job losses. But the absolute most immediate crisis on their plate is housing affordability. To tackle this, experts are suggesting the Fed might actually revive a strategy known as Operation Twist. Let's break this down simply, no jargon. Instead of their normal operations, the central bank actively sells off short-term government debt, and they use that cash to heavily buy long-term Treasury bonds. The specific goal here is to artificially force down long-term interest rates, like your standard 30-year fixed mortgage, without reigniting short-term inflation. It's essentially a surgical economic maneuver designed to unfreeze a totally stalled housing market.
And that entire monetary strategy revolves around one deeply psychological number: 4%. Breaking below a 4% yield on the 10-year Treasury is widely considered by experts to be the singular unlock for the 2026 economy. Right now, we have millions of homeowners wearing what we call golden handcuffs. They secured those amazing 3% mortgage rates during the pandemic, and they absolutely refuse to sell their homes if it means having to take on a new 6.5% rate. I mean, who would, right? So as long as the 10-year Treasury yield hovers above 4%, the housing supply remains artificially constrained. 4% is that magic psychological tipping point where the math finally makes sense for families to actually list their homes, upgrade, or refinance.
And that brings us to our final section, Section 6, Unlocking Economic Growth, the final puzzle piece.
So the crucial point is to think of this as a massive, entirely predictable economic domino effect. This is exactly what financial advisors use to model future consumer spending. It all begins when the 10-year Treasury drops below that critical 4% threshold. Once that first domino falls, mortgage rates organically follow suit, providing immediate relief and triggering a huge wave of refinancing. This in turn leads to a massive surge in housing starts. And from a macro perspective, building just a single home stimulates over 100 other industries. We're talking everything from lumber and copper to home appliances and your local contractors. This whole thing cascades into the final step. Vast amounts of money are unlocked. Between the monthly mortgage savings and booming construction payrolls, discretionary capital floods directly back into consumer wallets. That acts as the ultimate engine for broader economic growth. But make no mistake, without that first domino falling, the entire chain reaction just stalls out.
Wow, we have covered a tremendous amount of ground today, looking really deeply into the signals driving the 2026 economy. We've seen how the market is pivoting from that hyper-concentrated AI boom toward a much broader rally favoring small-cap stocks and deregulated banks. We explored the massive, but highly restricted, capital flowing into tech IPOs and juxtaposed that with the retail investors' very accessible shift toward crypto. And finally, we tied it all together with the absolute critical requirement of the 10-year Treasury dropping below 4% to unfreeze the housing market and stimulate global spending. As we look at all these tectonic shifts, the overarching lesson from top financial advisors is incredibly clear. Agility is key. So I want to leave you with this provocative question. With all of this expert data now at your disposal, how will you adapt your own financial strategy for 2026? Thank you so much for joining me for this explainer, and I absolutely cannot wait to explore the next topic with you.